Righto, buddy miners, end of the week, but the start of the rise of Axis Mining Technology. That's just our start of a never-ending rise. Trusted.
I love that Thursday's the end of the week.
Yeah, because we've pre-record tomorrow. Got a bloody. We've got an episode that is quite in parallel with the goodness of Axis and being the trusted drill hole survey instrumentation provider. We've got Mr. Are we going to reveal him? Who's on tomorrow?
Yeah, why not?
Why not?
Go for it.
Big Dave Franklin come back on.
He's back about a year
Co-head of
after.
Argonaut Funds Management. Bloody, mate, shot the shit. Great. It was awesome. Bloody stay tuned, late drop Friday, Harvey. Mate,
Awesome.
bit going on, Jay Benedict Dorling. Bloody Whitehaven, mate. What is, mate? You're going deep.
I got a bit of the coal fever again. So I'm going to talk about Whitehaven, two parts to it. The full year results, mate. And then we've also got the big sell down. That's the real eye catcher. And then also one I saw tick through last night, CONSOL and Arch, a big merger of equals in the good old US of A. So that's one that I'll add a few comments to. Didn't have the chance to go super deep on it, but I found it pretty interesting.
Oh, me and GC have headed over to the bloody, to Quebec, going in deep to Shaki Wanan.
Yeah.
Bloody, we're the PMET PEA is out, and we're just going to, the new name is the Shaki Mine. We're just going to say that's our abbreviation.
Just to abbreviate
the
it for
Shaki
the show.
Mine. We're going to get right into that. JD Whitehaven, mate, take us on a journey. Me and JC have dressed in black in honour of your segment.
Alrighty, let's do a bit to chat about here. So let's start with the sell down of Blackwater first, because that is, definitely the more interesting part. So selling 30% of Blackwater, for those that didn't see it, to Nippon and JFE Steel. So both of them obviously Japanese steel makers, and importantly, they've been long-time buyers of the product that comes out of Blackwater back when it was a BMA-owned operation. Now, it was actually pretty interesting. You don't see these Japanese conglomerates come out with punchy comments all that often. It's not really in their nature at all. But they had commentary that they gave to their market over in Japan, and they were as punchy as you see these guys kind of get. They're talking about the Queensland royalties here, and I'll read out a quick snippet. The royalties will certainly contribute to a decrease in the supply of steelmaking coal from Queensland in the long term. So I feel like we've sort of said this every day of the week, and it's a theme that's going to continue on. This has materially shifted up the cost curve in Queensland, and we've seen it in other states. We've seen it in other parts of the world too, but that's going to be a theme we're talking about. And if that's not like seriously bullish met coal, then I don't really know what is. But let's get into the deal itself. So obviously no surprise this sale that they'd flagged it when they were buying the assets off BMA in October of last year, talking about 10% to 30%. They've gone with 30%, and that's a sort of breakup, 20% to one of the partners, Nippon, and 10% to the other.
So how much, what's the dollars, JD? How much cash we talking, mate?
So what they're selling it for is advertised as US 1.08 billion, but I'll just remind everyone of what they actually paid for the mines themselves, because it's important to put it into context. So you remember they bought two mines, Blackwater and Daunia. They're just selling 30% of one of them, Blackwater. Now they paid US 2.1 billion upfront, and then there was 500 million in the first tranche of a deferred payment, another 500 million, and another 100 million after that. They're coming on the first, second, and third anniversaries of the deal. And then you've also got US 900 million in contingent payments, depending on what the relevant met coal price does over that period. Now, ones they've been a little quieter on is the 430 million Aussie in stamp duty and transaction costs, plus another 125 million in transition costs. So what they call as business sort of readiness and IT transfers and stuff. They're actually way more costly than I'd anticipated. Yeah, now, they were the terms, but obviously you've got today's deal, like I said, US 1.08 billion upfront. So you can almost chalk off, almost half of that upfront payment they had to make, and obviously 30% of the future production. So that upfront payment with a bit of, back of the envelope math becomes Aussie 2.1 billion or US 1.4 billion. if you're adding in those transition costs and those transaction costs. So it's a material change. And I think it's worth sort of looking at the balance sheet, and then we can kind of get into the thoughts I had after digging into the deal in the past couple hours.
The money miners will have to hold on for JD's evaluation of this. Is it good? Is it bad? Is it cheap? Is it expensive?
All right, well, we'll have to hold fire for 2 more minutes, Matty, because I think it's worth on the edge of your seat. I think it's worth chatting about the balance sheet, because they finished the financial year 1.3 billion in net debt Aussie. Now, the sell down's going to have a $150 million tax bill attached to it, and then they're going to get the rest of that cash in the first quarter of next year. Now, just bearing in mind, US $500 million goes out the door at the beginning of April. That's the first year anniversary. And then 3 months after that, you've got a potential contingent payment that's capped at US $350 million. And it's sort of linked to a price of US 159 for the index that they're using. The current price is $40 over that before you take into account the relativity of what they actually get versus the index. But it does look like there's going to be a bit of contingent paid.
Yeah, right. It's funny talking numbers in coal mines, met coal mines, after talking gold mines and stuff. They're just
amazing.
Heaps bigger. Like, they're freaking huge.
It's pretty refreshing, isn't it?
Oh, bloody hell. And like, even when you were talking about Yancoal the other day about how much debt they paid off to get to this stage. Was it like $3 billion or something?
US.
Yeah. Oh,
insane.
Friggin' phenomenal.
Just crazy.
These are just huge. Yeah, just from a little bloody seam of swamp shit. Bloody unbelievable. Anyway.
So here's another big number, Matty. Another 500 million roughly. That's the midpoint of CapEx to go out this year alone, this financial year. But, I think they're in the clear here. I think they've put to bed any doubts that they're going to have to go to the market and sell new shares, in my mind. And, you kind of think about the balance sheet more broadly. They've said they're not actually going to retire the debt, so they're going to keep a bit of leverage on the cards. But they are in a super, super healthy position now with this sell down and everything. So now we can kind of get into, is this a good deal? Is this a bad deal?
Yeah.
How
does that 1 billion for that ratio fare?
Mate, this is a good deal. And again, it's just worth looking at it in the broader context of the acquisition of Blackwater and Daunia. They are just, it was a masterful transaction in hindsight. It's just aging phenomenally. Like I said, the whole cost curve is moving up in Queensland. That's not just because of royalties. I mean, a lot of these cash cost curves have moved up because every single item that goes into that has moved up, and then you've got the royalties going in on top of it. But just think about this and think about the business from where it was like 1 year ago. You're bringing in great partners that are really aligned with you today. The terms are great. They've paid a pretty decent price. The cash is coming in upfront as soon as that settles in the first quarter of next year. They're going to take a management fee because it's going into a joint venture type structure. They're going to get the cash flows until that kind of closes. From where they were 1 year ago, they've brought in 2 decent met coal operations. You can kind of say what you will about Queensland as a jurisdiction. And here's the big one. They didn't even have to dilute the shareholders. Yeah, the dividends and the buybacks went on hold for a period and everyone was up in arms about it. And we'd been a bit critical, more from an angle of what management was incentivized to do at the time, because that was pretty opaque. But they are in a seriously stronger position now than what they were a year ago. They're going to be net cash in, not all that long a time. They've got a great foothold in a market that is structurally super attractive in my eyes. And, hopefully they can manage the costs and make good money out of this. But I think they can be sort of pretty proud of the work that they've done over the past year and how they've executed it.
What do you think would happen if they didn't sell a stake? Like, what were the implications for them? Just way more geared?
They'd had only shorter term bridging facilities in place, so they would have had to refinance things. And when you're running with such a relatively high gearing ratio, you're just exposed way more to any sort of cyclical downturns, any bad weather, any of those sorts of things. It can just whack you that much harder. So I think it's just it's the kind of prudent thing to do, and it's what they were going to do all along. Like I said, they've been flagging this from day one.
Are they going to do the same at Daunia?
I don't think so. Blackwater's the main one here. It's far bigger than Dornier. Yeah. So I don't think they are pressured to. I don't think they need to.
Yeah, right. Okay, so what about the full year results that come out? I'm glad you do all these full year results. Fucking anytime I see NPAT and EBITDA, I'm just like, whoa. Need some education there.
There was a fair bit to wrap my head around. So I thought the best way to do this, because we've got a bit to talk about today, would just to highlight the three most interesting parts of the call today. Now, first up, costs. This one comes screaming out at you if you've followed Whitehaven for a little one. The unit costs came in way higher than expectations. So they're talking about 140 to 155 bucks a tonne. That is on track to double from 4 years ago. Now, of course, the Queensland assets have come in. They are structurally higher in cash costs, but it's still a pretty phenomenal increase in their cost base. And if you look at where the driver or what the drivers are of this increase in cost, you've firstly got less tonnes coming out of New South Wales, like we always talk about. Less tonnes equals higher costs. But on the Queensland front, I'm going to give them the benefit of the doubt here, because they've taken over assets that are both, like I've said, structurally higher cost, but they've also come out of BMA, who just run things way more expensive. They've got way more, Matty, they've got way more people in place than they perhaps need to. So it's hard to kind
lunch breaks. BHP.
Exactly. All that
lunch break.
All that sort of stuff. So it's only been 4 months that they've had the assets now. And I'm pretty confident that they can run these leaner. We'll see how much leaner we're kind of talking about. It'll take a bit of time, but they've already recalibrated the workforce. Unfortunately, that meant letting go of a couple hundred people. There are a couple other concerns on the unit cost front. This sort of same job, same pay, when you talk about labour hire and all these kinds of things, are hitting people to varying degrees. It looks like they're getting whacked around quite a bit by it. And then another theme that we've spoken about a bunch this week, delayed approvals, just amplifying all the above costs. I think from their perspective, they'll be hoping that amplifies the price of the products they're selling. But for the time being, the cost base has just it's just notched up quite a bit there. One more sort of comment to make on the cost base. It's pretty disappointing when you look back at what they guided to about a year ago when they bought the assets. They were talking about the costs for the 5 years to come, and they were talking about 119 bucks at Blackwater and very close to that at Dornier. So it is significantly higher than what they'd kind of guided to there. But if they can, if the coal price stays elevated, then it's kind of water on the bridge.
Talk.
Love a bit of talk.
Oh.
Need a little breather before I get into the next one.
Jeez, bloody mate, JD, you're bloody resident met coal expert now. Right, next.
Mate, you're talking me out way too much. So the second point that I found super interesting is that they had pretty poor relativity. So what they achieve in pricing versus the index, they're kind of benchmarked against. I'm specifically honing in on the Queensland assets here. They realised overall 74% relativity to that index. That equated to a realised price of US 180 bucks. So historically a pretty healthy price, but they'll be hoping they can get, again, much closer to what they guided to when they bought the things just a year ago.
It didn't take Einstein to figure out they had bad relativity.
Jesus Christ.
On fire.
You're killing
well
it,
done,
mate.
Well done. Alrighty, last one before we talk about lithium, guys. There's no China sales from this business. So if you look at the pie chart here where everything goes, it's pretty interesting to see it goes, bar a little bit in Europe and what they call other, predominantly to Asia, with Japan making the bulk of it. Now that's kind of interesting when you compare it to Yancoal, who we spoke about a couple of days ago. Now, obviously, Whitehaven's a bit of a different blend now. They're, it's got a 60% met coal versus Yancoal being way heavily weighted to thermal coal. But I just thought that was kind of interesting, and tying that in with the bullishness that these met coal producers have around India is pretty astounding. I mean, we'll chuck up another chart here, and the growth in India, pretty much every other country is either declining or staying relatively flat. India is just growing phenomenally according to the forecast that they kind of use here. And we touched on, I think, on Stanmore's results quite a while back. But it's interesting. All these kind of met coal players have they've cottoned onto this, and they're big India fans. So it'd be interesting over the next 5, 10, 15 years to see how that kind of eventuates. A lot of people hoping that India obviously is that kind of China 2.0.
Isn't that funny, bloody looking at it's obviously the dynamic because China obviously mine a lot of met coal. Is that right?
China have met coal. They've gone very hard at it for the past few decades. So they've got thermal coal as well, which they use to power a lot of the factories and industry across the country. But they have historically come to Australia to buy the higher quality Bowen Basin met coal. And
just looking at how much more is coming out of India, there's more going into India, seaborne demand for met coal going into India now than China. And it just friggin' spreads from there. That's bloody, would never have thought that.
No, but even by the time you get to 2040, 2045, even by the time you get to 2040, 2045, like the sum of India is almost equivalent to the sum of every other country, right?
Very good.
Amazing.
Yeah. Right, good work, JD. What's the spark chart done? How's, because Whitehaven really haven't had the big met coal kick yet, have they?
The market reacted very well. When I last looked, they were up 6% on the back of this news. I mean, you're sort of balancing higher costs. That was a down against expectations, but the sell down really outweighed that, which people were pretty stoked about. And they paid a smaller dividend, but the proposition of those capital returns is looking good again.
Yeah. Oh, very good, JBD. Right, let's get on to the next one. Old PMET's out with the preliminary economic assessment. Is that the word? PEA.
Yeah, PEA.
Preliminary.
That's right.
For the Shaki Wanan, which we're just going to call Shaki, for simplicity. So let's go through the figures. The bloody, I guess beyond James Bay, this is like the next sort of big bloody spodumene deposit in North America, you would say.
No, it's huge.
So go through the figures, what they've come out with. After-tax MBV, 2.9 bill Canadian, IR 34%. Stage one, so they're doing a two-stage approach. So the stage one net capex of US $487 million. So look, 24-year estimated mine life. They're targeting after two stages, 800,000 tonne per annum of spodumene concentrate, which would put that around the fourth biggest operating mine in the world when that does come along. So look, we'll go. I don't want to get too much into bloody operating costs and all that. I'll go through a bit, but far out to try and bloody talk about costs for something that's going to get mined in 2030 is freaking hard work. Yeah. I suppose you've got to give a guide at the moment. So probably the biggest change, you'd say, from where this was being touted before, even by the analysts of what they thought was going to happen, is that there's going to be stage one's going to be an open pit above sort of one end of CV5, and then stage two is going to be underground that is going to target the high-grade Nova Zone, the honeypot. And that high-grade Nova Zone's got 22 million tonnes at 2.1% lithium as a resource. Wow. And look, and that conversion will be probably pretty good because it's thick, and we'll go through in terms of what the reserve grade would be, and we'll go through that a bit later. So, it's friggin' she's a big humdinger. So, in terms of the amount for the capex they're predicting, so stage one, 579 million, so that's for the first 400,000 tonne, includes contingency. And then stage two is another US 383 million. So it's sort of 2.5 million tonne per time. And the second stage obviously includes the development of the underground. But then they've got this, I think this just came in this year, this Canadian Clean Technology Manufacturing Investment Tax Credit, CTM-ITC. So I think, and that's where they can actually, they're saying they're going to get back from that for stage one, 121 million back in the door, and stage two, 95 million back in the door. I'm unsure if it's like the flow through tax thing where you get it.
It read like a tax credit pretty much.
Yeah, so I don't know if it's like flow through where you get it after you spent it, or if it offsets future income tax. I'm just not sure about that, but they're sort of taking that into account for the net capex figure. So now they've got so it's DMS only, 69% recovery in DMS only with no flotation. I first saw that, I'm like, sheesh, that's pretty bloody pretty bullish, but.
I was going to say, Matty, for the money miners, what actually is DMS?
Oh, dense media separation. So instead of because spodumene's denser than normal rock, so you just in a basic term, I'm pretty sure you just spin it around and the heavy shit goes to the outside, and you take that, and if it's denser, it means it's spodumene and not waste.
Okay.
So it's just, it separates things based on their relative density.
Okay.
So, mate, big Kenny Brisden, he'd be loving DMS only after fucking around with the Pilgangoora flotation for bloody so long to get that up and going. Be like all his Christmases come at once. Yeah, as I said, I looked at 69%, but then you look at the actual MET test work they've done, and it's like 20 plus samples, and pretty much everything above 1% seems to get well above 70% recovery, some even into the 80s for DMS only. So it looks to be pretty consistently coarse spodumene crystals. So look, the test work backs up that bloody 69% and probably shows it's
might
actually
even go
it's
a bit
actually
more.
Exceeding that. So and that's so this is for, so you see the numbers they quote. So they'll talk about the lith spod price they've used. I think it was like 1375, but that's for SC 5.5. So it works out that they're using in the deck 1,500 US. So obviously it's essentially half that at the moment. But as we said, it's not getting mined until 2030. So we're you won't be turning it on tomorrow.
No.
So
how about on the operating cost?
Well, like, the only thing, won't like go into the cost too much, but you can see that due to the remoteness of it, because it's, you know, in the friggin' middle of nowhere in Quebec, the transportation is one of their biggest costs. Like, transportation is about 30% of the total operating cost. So that's after they've actually mined it, just transporting it the SPODCon to port. So because they've got to truck it 834 kilometres and then get it on trains to then take it to the port. So
it's a road trip and a half.
Yeah, so that's sort of their biggest or not bottleneck, but where a bit of cost gets added on compared to bloody, you know, shipping a bloody few hundred K or bloody imagine you know, bloody Andover. God, that's only going to be 15 Ks to the port.
Yeah.
Far out. Get it, just chuck it in a taxi.
Is the concept here though that they're selling everything into the North American market?
Well, it's like, and the whole thing is going to be, it's this, you know, IRA compliant bloody spodumene. So like this is going to be potentially an ex-China supply of SPODCon. So whether it, I know they're talking about like what's going to happen with the downstream, like is whether like a partner will come in and look at maybe an integrated downstream. Like, God, you could build a freaking plant. If you got a downstream expert that wanted to build a bloody plant there, she'd save a bit. You still got to get that, still get the hydroxide and that out. But
at least it's not spod tons, right?
I think I'll be interested, and we'll surmise it all in the end, but it'll be interesting following this, that they've got this out now, what sort of activity at these pretty depressed equity prices in lithium, what actually comes to the table, because they've laid it out. It's like, this is, you know, what we've got at the moment, and it is of considerable scale. So they'll also hook into the hydro power line, so real cheap electricity. Now, I thought I'd actually do the numbers. Everyone says hydro's cheap, but 5 cents a kilowatt hour is the predicted price of electricity once it's going. What does that number mean? Well, that's when you call old Timmy Taylor for some bloody power facts and figures. I won't rattle these off like they're my own. Found out a diesel-fired power station, just the fuel component alone, if diesel's around $1.50 a litre, you'd be paying 37 cents a kilowatt hour, and then add probably another 9 cents on top of that if you got an independent power provider. So that's like 40 odd cents.
Wow.
Trucked LNG just for the gas itself is 22 cents a kilowatt hour. hooked into a pipeline, probably 15 cents. So hydro at 5 cents a kilowatt hour shows how freaking cheap that is.
Just like Latin, they quoted 4 to 5 cents as well.
Yeah. So it's DMS only, so it will use a lot less power than a flotation circuit. So because a shitload of power is required in the grinding of a processing operation. So Kathleen Valley, Limetown, their DFS said they have to grind down to about 180 micron because their flotation. Gold mines will go down to 75 micron. But these DMS projects, they only grind to about friggin' 6 mil. So heaps coarser. I don't think that's even grinding. I think that's just crushing.
Yeah.
Still classed as crushing to 6 mil. I think they got to crush down to 0.65 to 9.5 mil. That's the sort of it's like a 3-stage DMS circuit where they have 3 different sizes to optimize the recovery. So that's like the range of the crush size of the rock. So you do save power on processing. It is an underground mine that they're proposing for the stage 2. So obviously the ventilation and associated electrical machinery underground uses a lot more power than an open pit. But look, when your power's a third of the price of a frigging gas-fired power station, you're still saving shitloads on power. So there is the capex associated with it, because they do have to hook into the transmission line of the hydropower, which is about 55 k's away. So you obviously got to chuck that line in. But just the fact that they can save so much power from the hydro and then probably even save some of that power from filling this joint with SMEC VSDs in the underground.
Oh, geez.
Bloody imagine the shitload of secondary vent fans going in this underground. Once you see the schematic, you'll understand. But if you put them two together, it's like they're actually going to make money out of using power. If once you get the SMEC VSDs on there, it's like you're going into negative power costs.
Yeah.
People are just going to give you money to use power.
The ultimate battery is clean as a bloody whistle by the end of all
Hydro
that.
SMEC VSDs. Bloody unbelievable. And look, unfortunately, most of the mining world isn't the beneficiary of cheap hydro power. Not saying that you may as well save a buck while you can. Mate.
Oh, it's the collaboration you never thought you'd needed, hydro and SMEC VSDs.
Yeah. So
bloody awesome.
As I harped on last week, for everyone that in Australia that is non-hydro, the only way you're going to even get close to hydro is getting SMEC VSDs in your underground mine. They're in the tunnels over east.
Yeah,
They're in the Sydney tunnels. They're in the West Gold mines. They're in some Goldfields mines. Mate, they're going to be over at Windfall, I reckon, if they're in Goldfields already.
Ooh.
Marty Law, we're taking you to North America.
If you're running on diesel, just silly not to use it. Hey?
Oh, isn't it? What, JD? So yeah. Now look at the layout of what they've proposed it's going to look like. So you'll see the CV5 open pit on the left. That's what's classed as stage 1. And you'll see an orange line to the right of that pit. So that's where they term it as a dam. So you've got the lake, which is essentially it's like a big fucking dam. It's like a salt lake. Where it's not like a flowing river or anything. So they've got that's where they have to, that orange line's where they pretty much put a big fucking bund and block it off. And then, so you might have water on one side, then on the other side, the water sort of drains off by gravity. So, and that's the sort of the skinny, and that's I guess the skinny part of the lake, where you're gonna where they put that in, because I think previously when we were talking about it, like that high grade Nova Zone, which you can see to the right, where it says CV5 underground, that was going to be an open pit. So it's obviously to bund off to the east of that to let everything drain off was obviously a lot bigger job. But now they're proposing to go underground. Heaps fucking easy because they don't have to do anything to that. The only time they'll have to, potentially bund that off and drain that part of the lake is if they mine the open pit material above that Nova Zone. But that's fucking decades after the freaking thing gets even started. So that's very, very long term. So,
and how does the underground sort of work, Matty?
oh, mate. So she's a fucking, she's a bloody, these underground lithium mines like this in Linetown, like they're fucking dream ore bodies, like, because they're just freaking, the strike length on them is that long. I was talking to me mates that are working at Kathleen Valley. They said you just go in and there's just fucking lithium everywhere. Like it just goes for freaking hundreds of meters. Like you look at this one, like bloody, I think it's like a kilometre of strike or something, like the actual length of the ore body. And then you look along the actual cross section of it, there's like 3 rows of stopes. So you picture, the best way to think about it is like, think of the Never Never ore body, Spartan's one. That's like one single stope per chunk, but then overlay that two times. That's what this is in terms of the thickness. So you actually, looking at that cross section, you actually take one stope, fill it, then just go straight behind it, and then start working. Fucking she's pretty chunky. So and the best thing is if you have overbreak in these stopes when you got these thick blobby ore bodies, the overbreak's ore. Who gives a fuck? Just send it. More overbreak, the better. More ore. If you're in the middle of it. So it could have been a sub-level cave, this mine, looking at the ore body, because it's that thick sort of thing that goes down. But I don't think a sub-level cave caving into a lake above it would be such a good idea.
Safe, maybe.
So,
yeah.
no,
You're all over it.
And
we're talking 2 million tonnes per annum from the underground?
Yeah, which will fucking piss that in, you'd think. Like Linetown's 3 million tonne, going to ramp up to 4 one day maybe. 2 million tonne with this size ore body and this strike length, and just a pretty, I think they got the same philosophy as Linetown. I think I read it's a continuous loop, be one a down decline and an up decline. So it should just be a friggin' rock factory. So they'll have to paste fill everything. But yeah, won't be, you just want big fucking fat ore bodies. It's just easier. So you look at the size of that, to get 2 million tonne out of that for a big thick ore body with multiple stopes with big long strike length and one access, compared to Bellevue saying they're going to get 1.6. It shows how much easier 2 million tonne out of this is compared to trying to get 1.6 out of that mine that is a narrow vein ore body. So that's the bit of the contrast there. And they've definitely got options up their sleeve in terms of the strategy. As I said, we're predicting the friggin' future in 6 or 7 years' time, but it's when you look at how much spodcon comes from the underground, like over for the 800,000 tonne, over 500,000 tonne of that is from the underground in the early years, just because they got such high grade material down there. That's based on the 2 million tonne per annum coming out of there. All lithium price dependent, but the case they're putting forward is they're going to mine the stage 1 pit and then use the cash flow from that to build the second. They'll build the first 2.5 million tonne train, use the cash flows from the pit and that train to then do the underground and build the second train to go up to 4.5, 5 million tonne. So the other option they have is literally you could just develop a high grade underground mine first and then have that feed the first train. So obviously pays things back a shitload faster if the material's coming out of the hole at friggin', you look at the grade prediction, like 1.6 to 1.8% lithium, like considering Linetown's like 1.4. So it shows what that underground could do. Or, as I said, all price pending, but who knows what the fucking spot price is going to be in 2030 once this is going. But your lowest risk option is always just to go straight to the high grade, because grade always wins. So probably similar to what a Cisco and Goldfields have done at Windfall that we talked about the other week, like where they actually, that mine is developed friggin' well ahead. They're at the ore and in there and just haven't even built a plant yet or permitted it. So look, depending on the permitting and how that all works with this, if they can, I assume they'll be able to, they could, if you're going to bloody take the risk, you could actually start developing the underground mine in parallel with final FID and friggin' all the final permits to come to actually start processing and everything. And then once she's there, just fucking start chucking underground high grade in. So they've got that option up their sleeve. They could go either way. So that's the mining.
That's the mining.
Now, in terms of finances, this is where I hand over to
Now we're
LEGC. You want to talk cash?
Let's talk cash.
Woman.
Alrighty. So as we said before, so that's with the stage 1 and stage 2, we're looking at a 800,000 tonne per annum operation here. At steady state of SC 5.5 spod con over 24 years. So all of that at a US 1,500 SC6 spod price gives you a post-tax NPV 8 real of Canadian 2.9 billion and a post-tax IRR of 34%. So I'll definitely give them a tick for advertising their post-tax on the front page and using a proper real discount as well. One interesting thing to look at is the post-tax NPV CapEx ratio. So essentially for every dollar I'm spending on CapEx, how much NPV am I getting back in return? So at the US 1,500 per tonne SC6 price, again, assuming stage 1 and 2 CapEx, it's just shy of 2 times. So US $2.2 odd billion of NPV over US 1.2 billion odd CapEx.
Does that include the potential? Because it's not a set in stone thing that the tax
that doesn't
rebate?
include the tax credit.
So that's the cherry on top.
That's a cherry on top. Yeah. I mean, I wouldn't use it as my base case, but it's absolutely something that can add a bit more sugar to the story once that's firmed up. That's okay. As a comparison, another company who's put out a PEA relatively recently, Latin, which is currently subject to that takeover from Pilbara, their PEA showed about 400,000 tonnes per annum over 11 years. They had about US 300 million of CapEx that's across their stage 1 and 2, and a US 2.5 billion post-tax NPV 8 real. So if you do that ratio again, that's at 8 times, but admittedly they use a US about $18.50 a tonne SC6 price. If you apply that price to the Patriot situation, that generates a US 4.4 billion NPV roughly. So again, if you calculate that ratio, you brings it up to about 3.5 times. So it's interesting because both are DMS only, both are SC 5.5. There is a bigger plant throughput at Patriot, and the all-in sustaining is they're relatively similar, but it's marginally higher at Patriot.
Also interesting to note that they're both staged, the two you're comparing there.
Yeah.
Doing the old stage 1, stage 2.
And I think the key differences is probably where they are in a couple of, because you combine in stage 2. So you got, as I said, they got the transmission, a pretty big transmission line to put in. State like the underground is
component, Patrick.
Underground. So you got the underground capital development obviously adds a lot. They got a paste plant to put in. I think they got costs for fish rehabilitation. I think that was like
another 20
million. Then all the friggin' ventilation infrastructure for the underground
component,
and fuck, there's probably shitloads I missed.
Underground,
and the fact of how remote it is
adds to it as well.
And I know that I think we've touted that probably labour will be significantly cheaper in Brazil compared to Quebec. So and when I looking at those capex numbers. Just from that's the thing. They work on these things for months. We're supposed to bloody get an idea in 4 hours. It's bloody hard work, but it did. It looked realistic. Put it that way. It didn't look like it was friggin' anything was out of the question. So I think there is some key differences there.
Absolutely,
and it's a PEA as well within a sort of plus and minus 30 odd %. So the numbers are a bit of a rough and a good kind of starting point on the way to seeing what it could be in a few years' time.
Yeah, that's right. And I think, it's important to take these things with a pinch of salt. And as you mentioned, JD, these things aren't getting produced, or, for another 4, 5, 6 years. So a lot to happen between now and then. Moving on to the pricing. So the pricing assumption they used for the PEA was, as we mentioned, SC6 of US $1,500 a tonne, or SC 5.5 equivalent of US 1375 FOB. This feels about right. Most people feel SC6 should eventually land in this sort of zone of US 1,250 to US $2,000 a tonne. Recent consensus SC6 forecasts, thanks to a money miner for that as well, see prices sort of tick over that US $1,500 mark in around 2028, and PMET's looking at commissioning and production at their project in 2029. So, assuming this is how the future pans out, should work out okay. And the other thing to note as well is PMET's price assumption, looking at other peers' studies, and that is definitely on the lower end or more conservative end, which is good to say. And you can see that MPV sensitivity table there as well at different prices. So right now it's sort of got a negative MPV on it, but at those Goldilocks zone ranges, it's pretty huge, right? Even just on the operating cost front, not to get too deep in it, but again looking at some peers, so PMET have got US just shy of $600 a tonne all in sustaining. Latin is about US 536 a tonne. Pilbara, for example, is US 483, and then Greenbushes is, oh God, that's even lower again. But that's huge. Probably more interesting is the funding strategy. So they've sort of, again, we've spoken about that phased development, intended to obviously reduce that upfront funding requirement. They've said they've, received a lot of interest from all these tier one lithiums, supply chain participants, OEMs, trading houses, all the rest of it. Then sort of looking at a combination of debt, equity, government programs, and internal cash flows. With respect to the government side of things, there's those tax credits we spoke about earlier. The company reckons up to about $790 million of expected project costs may be eligible under this sort of tax credit program, which could, they
get up to 30% of that, maybe.
Yeah, as a tax credit. Yeah. The other government side of it is they're sort of targeting senior debt funding from government agencies and, export credit agencies, and, the fact that they're, potentially IRA compliant lithium projects certainly helps with that. It was comforting to see, at least in this disclosure anyway, that there's no sort of royalties and streams sort of touted as potential funding options as yet anyway. I thought the mention of strategic investments was interesting. I mean, that could mean a whole range of things. It could be, a strategic investment at the project level. It could be a strategic investment at the corporate level. Be interesting to see how that plays out, given that, the scale of this project. It's looking like it's going to be in one of the top 4 biggest producing, lithium mines in the world. Yeah. I wouldn't be surprised if there'd be some project level investment.
Yeah, it depends if Big Kenny wants to do it again.
Yeah.
Because that's that's what he did at Pilbara Minerals. They still own fucking 100% of it. So whereas, look at the way Greenbushes was, and then, a lot of the MinRes stuff was all, JV arrangements, whereas Pilbara Minerals, and they were 100%. So if they're going to repeat that process for this, it'd be interesting to see. I'm sure they're going to get fucking, if there's any change in sentiment on lithium, there's going to be plenty of big mobs looking to they'd just be coming through the door to inquire about a bit of
100%.
a project stake or something. So
I think, it's just that comparison, right? Again, sort of, taking away a project interest versus, perhaps equity or share dilution at the corporate headco. What's it depends on their sort of the equity markers at the time that you're considering, should I do A or B as well. So it'd be interesting to see what they'll do there.
It depends on the lithium market. Like
very much so.
Most so in terms of look at the funding, how Liontown funded this after they had to redo and do the bit of a raise and everything. But when it was flying, money just got thrown at it. They could get as much fucking debt as they wanted. And there's just the sentiment was just take my money. We want your product.
Yep.
So
we saw it not that long ago. Obviously we saw the big offtake ones you're kind of talking about there, Matty, Ford, that facility. But even the LG one, that was, what was that, 2 months ago? So it'd be interesting to see if there's any of these off-takers forthcoming in the next 3 or 4 years. Obviously, it'd be very much centered around what the temperature of the lithium market is at that point in time, but that's one I'm keen to see.
Right, so GC, what about the good old approvals and permitting? That's the big bloody question for North America always. Yeah. Tell you what, fuck it, I'm probably more comfortable with Quebec than Australia at the moment after friggin' this week between the Regis thing and then also the Section 10 with Bellevue. It's fuck me.
Oh, geez, maybe Quebec's a new place to go. Far out. So
Quebec.
Look, it's a bit of
Go to Brazil.
Oh, and Brazil.
I like Brazil and Japan and South Korea.
Love it. So, as usual, it's it is a bit of a process. They're sort of, right in the thick of it as we speak. So, the next sort of steps is putting a environmental impact assessment report, which has got it'll flash up the table here that sort of details what that sort of involves, advancing to a feasibility study and then submitting that to COMEX and also doing an impact benefit agreement as well, sort of commitments to the local committees and things like that. So that'll, all sort of happen over the next few years prior to, construction and commissioning and production sort of in the late 2020s. But as far as what's next, there's that ECS submission, the feasibility study next year, followed by sort of the funding process to get all this up and away. They've got 101 Canadian million cash in the bank as at 30 June. They raised Canadian 75 mil back in May through a flow-through financing, which means those funds can only be exclusively used on exploration expenditure. And it looks like that'll cover sort of pretty much all the exploration till the end of next year. It doesn't leave sort of too much left over for other costs, but I think they should be pretty okay for now.
Yeah, I'll be with this the permitting and approvals. I'll be very interested to see how this project goes in terms of the fact it's so remote. When we're talking lakes and the Cree and everything, I can't imagine being that remote. People go there fucking fishing on the weekends.
No,
because it is in the middle of nowhere. So yeah, I'd be interested to see. I'm interested to see how this process works. If there's because you got the element of the Cree, the native title approvals, but then obviously the regulatory side of approvals, but. As we said, fucking Australia's shit these days as well. So bloody, I might have to move to fucking Canada the rate we're going. No, we're going to Brazil. Carnival. So how much they raised? So the flow through financing, what was that? $75.
75 mil.
Mate, that flow through financing is handy over there. It actually reminds me of beer flowing through Drew Harvey's throat. When I think flow through financing, mate, the amount of K-drill exploration contracts Drew has sorted out from bloody just sitting down having a couple of pints with someone he doesn't know, and that's not many people because he knows everyone, and they sit down there like, Druba, where do I sign?
Let's solve the world problems. Yeah. Where do I sign?
Mate, K-drill, you'd vouch for this, JD. K-drill they tick all the exploration drilling boxes for me. Mate, I heard they're the best mob to work for. They treat all the drillers offside as like they're their own children, not stepchildren, like actual full-blooded children. Buddy, the QA/QC on the RC and Diamond, mate, elite. Industry elite. And, mate, they're just the heart and soul of the WA goldfields for exploration drilling. I get emotional talking about them sometimes. Love Druba.
No doubt about it, Matty.
I can't wait. I'm actually well overdue for a pint with Druba. I haven't seen him since Diggers.
Oh,
Druba, you better pop
weeks now, isn't it?
Druba, you better pop in for one if you're in West Perth, mate. Bloody go, K-Drill. Right, JD, Arch and we digress. Arch and CONSOL. Never fucking heard of them.
What? Oh, really? All right, one more on Patriot. What was the takeaway? We went in the weeds heaps, but interesting to, kind of take the temperature on what you guys thought, see what the market kind of reacted to it. It was, from what I saw, it was just flat on the day. So
yeah,
you think just in line with expectations?
Flat or up margin. I think it was in line with expectations. I think, they ultimately had to put, even in this sort of lithium price and, equities environment, they have to put something out there. They sort of said, hey, look, this is what it is. Yes, okay, fully aware of the lithium price at the minute, but, when she's ready to go, she'll be, ready to go. And they, seem to be all going full steam ahead. So,
yeah, it was fucking detailed. I thought it was bloody very detailed. And, I just think now, I don't know if this was something that companies were waiting for, like people that would have any interest. Because as we said, between like when we were talking about Latin the other day, you'd probably take the Shaki ore body over Latins. There's a bit, as we said, there's obviously between the transportation and a bit of extra capital to go in. So there's a bit of a toss up there. But in terms of that underground, that's a pretty fucking phenomenal ore body. And you're thinking globally, what's out there if you want the I won't say the word tier one, but like a high quality ore body like. This one's it. So whether this PEA is now a bit of a catalyst for your other fucking lithium companies or people that want to be a lithium company to get interested. Like I know Rio's got a lot of ground around there by the sounds. So if they're actually going to bite the bullet or a friggin' Albemarle might get interested again, don't know. Or if they're going to fend them off and do the go alone and bloody Kenny Brisbane 2.0. So, yeah, a lot happening. But Jesus Christ, after fucking seeing them, looking at them 40 to 50 cents, and after seeing what's happened with Latin, with Pilbara's investment, you'd think this one would be in the targets as well. What do you think, JD?
Good stuff. 640 market cap. I mean, at the time when we spoke about it a year ago, I thought it got way too carried away when it was.
Oh, it did. Before the mineral resource, fuck, that was when the mania.
It was crazy.
Because you had the lithium mania, and then this one was at the top of the lithium mania, so it was just fucking madness.
You're just kind of in that part of the Lassonde curve, and you will be for quite a while to come. So it'll kind of move broadly in line with what lithium does, but they're pretty well insulated. They've got a good cash amount. They've got their work cut out, so they're not like an operator that's losing money day after day, just operating in a loss. So I don't know, just keep watching it. I don't think it's going to do anything crazy anytime soon.
Unless there's corporate activity, effectively.
Yeah, of course.
Or a friggin' lithium bloody spike. Arch and CONSOL.
Biggest deal in the coal space in America in 13 years.
Oh, that's why I haven't heard of American coal. Got to get up to speed here.
American. Yep. So this one's overseas. You've got essentially, roughly talking a met coal company and a thermal coal company coming together. The pro forma company is going to have 13 operations. There'll be a few moving parts, but a combined pro forma market cap, a US 5.2 billion. So
you're like a bloody power station, coal-fired power station turbine of information for the coal industry, JD, today. Mate, you're on fire. Mate, the steam
just how
coming
the cards have fallen this week.
Oh, mate, this is,
so
fucking huge.
12 million tonnes, that's the old US tonnes of met coal, and 25 million tonnes of thermal coal. CONSOL brings the thermal, Arch brings the met. Also 2 export terminals, which is, not a part of the the combined assets that should be ignored because it adds real value and synergies, which we'll kind of get into in a sec when you can tweak things with the logistics and all these sorts of things. I mean, one of them's not totally owned outright, but I think it adds quite a bit to the narrative here. On the synergies front, 110 to 140 million per annum in cost savings and operational synergies. I think that is way more achievable than some of the other ones we'd seen in, the gold world, for example, recently in mergers we'd spoken about. You guys can probably guess the company we're talking about there.
Why is that, JD? Why are they more realistic?
So there's a couple of reasons for that. Firstly, they're just a smaller quantum on a much bigger combined market cap company, so they're just more achievable on that front. You've got your standard corporate overheads, which get wiped away pretty quickly. And then you've got CONSOL being one of the best longwall operators in the world. That'll help operational efficiency at the Arch operations. You've got logistical efficiencies because some of the operations are nearby to one another. There's facilities that are nearby to operations from the previous other company that can now sort of boat in well together and just bring down logistic costs. Remember, it's just an economies of scale kind of game in which they're operating. So you pull down the costs by a couple dollars a ton, and that adds up when you're doing, like I said, 12 and 25 million tons per annum. And then there's the other part, which I kind of touched on with the terminals there. You're removing the port costs because now that they're owned rather by the combined group, you're not having to pay the port costs for the party that didn't previously own them.
Oh.
So they're
real
pretty
synergies.
achievable.
Oh.
Well, I won't count the chickens before they've hatched, but I think there's synergies that can relatively easily be achieved on this front.
So they got more synergies than Paladin and Fission, besides uranium being the synergy.
This is true. Also more than Westgold and Karora, but
Gold
underground,
gold.
Western Australia.
Underground, Western Australia.
Western Australia is a small state as well. So there are a couple downsides, and we always talk about this with the good old coal names. The shareholders get furious when you stop the buybacks and you stop the dividends. So that's gonna happen again here. But I think we just spoke about it with Whitehaven, right? You flick them on in a few years and they hopefully come on bigger and better in future. And I'll give a bit of credit to Marty Law, who is obviously stateside and follows these coal names pretty closely. But the way he kind of spoke to this pausing of the buybacks made sense to me. So you get this seasonal weakness in the shoulder season over there, and the buyback on CONSOL has sort of supported the stock through that period of time. So you might get a bit of short-term weakness. That's one of the other downsides to the deal. But again, that's just a shorter term. And then, other things to kind of expect. You probably get a bit of asset rationalization. 8 of the 11 operations are longwalls. They're specialists at longwalls, so kind of anticipate that a couple of the open cuts maybe get passed on in time, but we'll kind of see how that goes.
Yeah, right, mate.
And that's about me, guys.
Mate, Matty Water would be so proud of you today. He'd be just like,
Graduated from coal school.
Oh, mate, it'd be like a proud dad moment.
It would have been a whole lot easier if we just patched him in for this.
You've done a bloody sensational job there, JD.
Likewise, a pretty action-packed week, hey?
It has been.
News.
Oh, yeah, I'm fucked.
Yeah.
Completely fucked. Bloody, probably going to go get shit-faced this half, I'd say, to celebrate how much work I've done.
Just let your hair down a bit, Matty.
Yeah, imagine how much bloody Axis Mining Technology celebrate after all the weeks they have.
Oh, no.
Geez, they'd be on the... No, they're not. They're a professional establishment and they just know a good win when they see it.
It's just BAU for them, though.
Oh, just another,
every week, every day, just checking a box.
Day at the office, bloody mineral mining services, open pit mining contractors. They'd be getting on the piss on Thursday for sure. Bloody got on the piss with Grant from VRIFY at Diggers. That was bloody good.
You met Grant at VRIFY.
I met Grant at VRIFY.com.
Champion.
Oh, bloody, and good old SMEC Power Technology, DSI Underground, Silverstone, CRE Insurance, Greenlands Equipment, K-Drill, Spark Charts, they're the partners, by the way. Can't thank them enough for giving us electricity. Hoodaroo, money miners.
Hoodaroo.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation, or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation, and needs.